We're talking about Michael Granoff, CEO of Pomona Capital. His company manages $6 billion in private equity. Michael, you've been coming to the World Economic Forum here in Davos for 6 years. I want you to tell me what you've heard thus far and what it tells you about the state of the global economy.
Well, I think there are probably two conclusions that I would draw so far. The first is that I've never seen such a divergence of view of where we go from here. So whether it's that the world is headed back, not necessarily back into a very deep recession, but that the recovery will be very slow, to people who think that we are on our way towards recovery. And the second observation is that the world is not a monolithic place. So what's happening in one region of the world or to one country is not necessarily happening to others, although they are interrelated, and so that the opportunity set is not bound by the overall global economic situation.
I want to go back to your first point for a moment, this divergence of views. Do you think this is philosophical, theological, or do you get the feeling that there just isn't enough evidence out there yet on which to base firm conclusions and make forecasts?
I think it's much more data-based, let's say, than it is theological. I think that people looking at the information right now are finding it very hard to draw conclusions, and so are we. We're forced to make macro kinds of considerations now that we didn't think we used to have to make, and it's very, very hard to make them because the evidence is inconclusive.
Let's talk about this whole issue of the world not being a monolithic place. By that, I assume you mean that one jurisdiction or one country may either be recovering at a faster rate than others, or that they may choose to take a different response to the crisis in terms of the regulation.
Right.
What does that mean for your business?
Well, when we invest globally, and so we're looking at private equity opportunities around the world and trying to look at where we think the wind is going to be at our back versus the wind being in our face. And so, for example, right now, where are we putting more attention? Well, like a lot of other people, we're putting more attention on Asia. We've recently made a number of investments in funds in Asia, and I met with some of the people here in Davos who run those funds, and they're seeing really extraordinary kinds of opportunities. On the other hand, you probably would look at the traditional buyout business, large buyout business, let's say, in the United States or Europe, and you'd say the opportunities there still exist, but they're slimmer.
We've heard so much about the opportunities in emerging markets, whether it be Asia, whether it be Eastern Europe, but it's mostly the BRIC countries that you hear about. It's one of the themes, really, of this World Economic Forum. Are we running the risk here with a regulatory approach that we take in the United States of driving capital away from developed countries and further into the arms of emerging markets at a time when America and the West need it more than ever?
I actually don't think so, and I think that is a philosophical point. I think that the reason that people are beginning to look and move their investments towards emerging market countries is because they have more growth. And I think it's driven by that. And if you look historically, the United States was often able to draw capital to it precisely because of its regulatory system, because people thought it was an even playing field, and they were nervous about investing in places where the playing field was uneven. And so I don't believe philosophically that what the United States is doing from a regulatory point of view is going to drive capital away. On the other hand, I think that obviously to the degree that governments go too far, that will be a negative influence, but I don't think it's a driving force here.
What happens, though, if all the capital does go to the emerging markets? Are you comfortable enough with, say, the playing field, the rule of law, capital controls to be investing that much of your company's money in those regions?
The key to your question is all of your capital. So we're talking about incremental capital moving in that direction. It's not that there isn't going to be investment in the United States, that there isn't going to be investment in Europe. We're talking about the marginal dollar, let's say, incremental money moving that way. And you're right, we're very careful about concentration kinds of limits. We are concerned about the level playing field in other countries. We're concerned about what happens in China and how that all works out. So are we willing to commit capital in that area? Absolutely. Are we willing to bet the farm? No.
Very briefly, what do you feel about the kinds of things that Jim Chanos has had to say about China, that it's a bubble, that the Chinese are inflating their growth figures, and that valuations really aren't in line with the underlying strength of the Chinese economy?
Well, luckily, that's a little bit above my pay grade, and I don't have to make those kinds of decisions day to day. But the only observation I would make to you is that there have been lots of people who have been predicting the downfall of China for a very, very long time, and they've been wrong consistently. And one of the reasons I think that they have been wrong is that I think the Chinese government, in good ways and in bad, is very, very good at sticking around. And they think very long term. They do what it takes to stay in power and to grow the country. And I think that I would probably be betting on them versus betting on the reverse.